Now folks, I know that most of you are focused on picking the right stock, entries, exit, market timing, but you know what? Growing your portfolio can be the difference between exponential growth and going belly up. That's right. It's not all about entry and exit. It's about building your wealth, maintaining your wealth, and growing your overall portfolio at the right rate. That's how fund managers do it. They're not looking at each individual trade. They are, of course they are, but they're not looking at it like it's everything. They're looking at the entire portfolio, the difference between the forest and the trees. And that's how you have to look at your entire account, and I'm going to show you and talk about it today. Here, I'll give you an overview of how I do this, but if you want to truly see the full power of what can be achieved when you combine these strategies, then click the button below to reserve your spot at my special free event with live trading on Thursday, August 29th at noon Eastern, where I'll show you how to use them together to increase your wealth by 10 times over the next 36 months. Clear your calendar for this one, because this could change everything for you. Register now. As you guys get more into trading, you're going to find out that your focus is going to shift from looking at the best trades and the best entries and the best indicator and market timing to growing your overall portfolio. That's the typical evolution of a trader. You start at the entry indicator, you look at the exit indicator, then you start looking at other factors, bigger factors. So let me save you some time and let me tell you what the biggest factors are in growing your portfolio. The first one, number one, diversification. If you don't diversify your portfolio, and what do I mean by diversify your portfolio? Trade assets in different classes. Let me give you an example. Stocks. Both long and short. You got to trade both long and short. If you don't like to trade short, put an asset into your portfolio that'll hedge your portfolio. For example, the bond market. The bond market is a hedge to protect you. In other words, when stocks go down, bonds go higher. A good one is ticker TLT. That's an ETF that you can use. That's one way. Another way to protect your portfolio is with an inverse ETF S&P. It's a S&P 500 that trades inverse to the market. The ticker symbol is SDS. So diversifying your stocks with inverse assets is one way to protect your portfolio. Another way to diversify your portfolio, and remember, diversification is the only free lunch Wall Street will offer you. I keep saying that over and over and over again. There's very, very little bit that Wall Street will give you, but diversification is key. Don't ever, ever put all your eggs in one basket. The best way to build your portfolio is through diversification. So, putting in long and shorts, that's one way to do it. Another way to do it is to start putting in assets that are not correlated to the stock market. For example, if you trade stocks, add gold to your portfolio. Gold is a natural hedge, very similar to the bond market. Add currencies. Anytime you diversify your portfolio, you diversify it. Anytime you diversify your portfolio, you spread your risk. Okay? So one of the best ways to build your portfolio is to diversify it and quickly build your portfolio. Diversification. The best way to diversify your portfolio is to either use assets that are not correlated to the stock market or use assets that completely divest you from the stock market. Uncorrelated or inverse correlated, meaning the bond market, the gold market, and uncorrelated, meaning the currency market, or you can go inverse with an asset like SDS, which is the ticker symbol for the S&P short position. That's an inverse S&P. There are many, many assets, but using inverse assets and taking away the correlation from the stock market, those are the best ways to diversify your portfolio and to increase your growth, overall portfolio growth. And keep something in mind. The typical stock in the S&P 500 has a correlation of 66% to the overall market. So try finding stocks that are not in the broad market. In other words, cannabis stocks, 5G stocks, small cap stocks, anytime you go away from the S&P 500, you bring in stocks to the mix that have less correlation than 0.66%, and that's another good way to do it. But again, all of these factors, less correlation, inverse portfolio, assets that are not correlated to the stock market, those are 3 ways to diversify, and those ways will help you increase your portfolio value and grow your portfolio. Hope that helps. Be sure to sign up below for the big event this Thursday noon Eastern. We'll trade live and chart our course to turn every $10,000 into $100,000. This is a free event to attend, but please don't bother if you're just in it to make a quick buck or get a few winning trades, because this isn't the right fit for you. It's about laying out a roadmap that you can follow consistently and methodically to grow your wealth for the rest of your life. Use the button below to register now.